Hello and welcome to this Monday's weekly market briefing. We've got lots to talk about, but firstly, hedge funds hit by lack of private equity exits, as well as that Bill Gross says Trump would be worse for bond markets than Biden, and finally, shipping rates spike as businesses expect more Red Sea attacks. We've got lots to talk about on the charts. Also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around soon to see that. Before we get straight into it though, make sure you subscribe. The first article to talk about is to do with hedge funds and them being hit by this lack of private equity exits. Now, the recent key struggle for private equity firms to return cash to investors is now hurting hedge funds as well. This comes as a result of many hedge funds' reliance on the same pension plans, endowments and foundations for fundraising. Now, of course, we've kind of covered this topic of a key issue within private equity exits quite frequently really on this channel, whereas often going over the key topics within the private equity sector. And arguably ever since the kind of rise in interest rates that we've seen and the kind of change in the macroeconomic environment, we've really seen a slowdown in private equity exits, with this lack of IPOs and other forms of private equity exits ultimately weighing on investors' ability to reclaim their cash that they invested, and ultimately also for the private equity firm themselves to return that cash to investors and then gain new investment from other investors. Now, this is seemingly also now affecting hedge funds, as this article does cover. But when we've previously spoken about these issues within the private equity sector and their exits, we have also noted the kind of growing strategies or new strategies which are being developed by these private equity firms to still enable certain investors to exit the firm and also enable the private equity firm to then take on new investments. So whilst there has been a slowdown in IPOs over the past year or so, maybe that's changed more recently, but ultimately as a result of the changing macroeconomic environment, IPOs have slowed down, and as a result of that, private equity firms have kind of created these new exit strategies, and one of those being basically this kind of second-hand market where these institutional investors which have invested into the private equity funds and firms are not able to get out their money through the more traditional exits such as IPOs, and therefore use this secondary market to sell their share within the private equity firm or sell their investment into the private equity firm to new investors. So therefore, we're kind of avoiding that traditional route within the private equity sector, which is IPOs or other forms, and as a result just using this kind of secondary market that's being developed, this grey market, which is far more between investor and investor rather than between the actual private equity firm and another investor. So it's an interesting development that we of course noted on this channel, as well as that to do with private equity firms raising new capital. We've also spoken about private equity firms looking to the kind of debt markets and that kind of thing to raise cash rather than looking for other investors, and that's despite the kind of high interest rates. But once again, that's through looking at these kind of grey markets or kind of secondary markets for debt to actually raise capital rather than these more traditional capital markets which private equity firms might go towards. So certainly there's been some very interesting develops in the private equity industry, and these private equity firms have had to deal with the changing macroeconomic environment, and it's likely that the kind of conditions of the macroeconomic environment is going to persist, right? We've spoken many times about the kind of warnings from Jerome Powell and others at the Fed about the issues to do with inflation and the likelihood that will remain persistent, and therefore the likelihood that interest rates will have to stay higher for longer. Obviously some data recently has kind of contradicted that, but ultimately the overall macroeconomic picture is still quite hawkish with regards to the Fed, and as a result the likelihood that the macroeconomic environment stays just as it is or close to what it is at the moment for quite some time is likely, and therefore private equity firms are going to have to adapt and develop. But ultimately the slowdown, as this article does note, is also affecting hedge funds. And I think this is also an interesting article, since very much recently we were also noting private equity firms beginning to work with other asset management firms, less so to do with exits, but more so to do with regarding attracting new investment, but not through the usual traditional institutional investors, but rather offering their wide-ranging services to a wider range of investors. The more modern, working day, everyday person, and that kind of thing, through these kind of new investment portfolios and new kind of wealth management services. So it's interesting to see these developments. Obviously, this is going off on a completely different turn, though, where we're talking once again about the private equity exits. But I felt that that was also important to note, just to kind of contextualize the developments recently within the private equity industry, with the institutional investors, with regards to this article, and hedge funds now rejecting many hedge funds' pleas for money during fundraising as a result of institutions lacking the cash to give investors. So private equity investors, these institutional investors, aren't able to get their money back from private equity firms and then invest that into hedge funds, as a result hurting the hedge funds themselves. Now the slowdown in cash distributions from private equity funds to investors has been a large part of this issue. Buyout-backed exits in the private equity industry fell to $345 billion last year, with this leaving the private equity industry to sit on a record backlog of 28,000 companies worth more than $3 trillion in total as a result. And this slowdown in deal making has ultimately made it harder for firms to return money to their backers. The reason why issues in private equity are affecting hedge funds is because both types of firms finance operations from the so-called alternatives allocation of institutional investors, which can include private credit, infrastructure, and real estate assets. And so ultimately the lack of distributions out of the private equity firms is now impacting the ability of investors to make commitments to other firms in the hedge fund space. So a very interesting article there on the topic of private equity, obviously, and now relating it to another key area of finance and the buy side of finance, that of course being hedge funds. So lots to think about there as well. Next article to talk about, though, is to do with Trump. If the article can load, but obviously we've spoken quite a bit about Trump recently, but we'll get straight into it. Now, the long-time fixed income investor Bill Gross has now stated that a Trump victory in this year's US presidential election would be worse for the bond markets than Biden. This comes as those like Bill Gross warn that Trump's return would worsen the growing US deficits, and therefore this would be bearish and disruptive for bond markets. Now, we haven't actually spoken too much about how Trump might affect the kind of markets should he return. We've kind of hinted, and obviously we've tried to relate any topics that we kind of cover with regards to Trump to markets, but we haven't actually covered any direct articles which cover the possible impacts of Trump once again on markets. So that's why this article is obviously so significant to cover and so interesting to kind of note when we are going to kind of analyze the charts later, and also when we're thinking ahead to the respective impacts that either Trump or Biden will have on the markets, and therefore depending on what the polls are, what markets then might price in for the US presidential election. And here we have, of course, a key fixed income investor warning of Trump's return for bond markets, as ultimately, when we've spoken about Trump before, not only have we focused on his kind of political campaign and the kind of battles that he's had to go through to kind of get to where he is now as the kind of front runner for the kind of Republican leadership, and now potential, of course, US president. Ultimately, we've also focused on the Donald Trump's economic policies, as that's kind of been the key thing that we've related to the markets. And a key part of that, of course, has been spending and tax cuts and that kind of thing. So any fiscal policy really, and ultimately the way we've kind of spoken about Trump's economic policy previously is that he's looking to kind of continue spending, but ultimately cut taxes. And what this kind of means really is raising debt and pushing the deficit higher. And of course we know that we're kind of at record levels for the current US national debt, and we've spoken many times on this channel actually about what certain economists and economic firms are kind of projecting for the future of US national debt should either Trump or Biden come to power. And whilst both are expected to cause national debt to skyrocket or at least rise over their presidency and after, ultimately Trump's kind of been the one that does look like will raise debt more, national debt more than someone like Biden. And that is because he is implementing this very fiscally loose economic policy where he's lowering those tax bans or getting rid of key tax bans, whilst of course continuing high spending, and that's what's kind of worrying someone like Bill Gross with regards to the bond market, as ultimately should the US national debt rise further and continue to push into extreme territories, bond market or at least debt ratings are going to be worsened or lowered for the US, and ultimately there's going to be a massive impact on the bond markets, as we've seen previously with other political leaders and their situations with spending and debt and that sort of thing. With Gross making these comments with only 6 months to go until the US presidential election in November. At the same time, of course, Trump is dealing with a range of court proceedings, and in only a day's time in Manhattan is expected to begin proceedings with regards to Trump's hush money case, which could make Trump, the first former president to be convicted of a crime. These comments are also hyper relevant because Trump is leading in the polls against Biden in several of the key states which are to decide the election. So a very interesting article here on a very important topic, and it's definitely something that you need to keep your eyes on. Next article to talk about, or at least last article to talk about, is of course to do with shipping rates and the kind of issues with regards to also Red Sea attacks, with the price of international shipping now having risen dramatically as a result of businesses preparing to ship goods for the festive season far earlier than usual. This comes in a sign of the far-reaching effects that the attacks have had in the Red Sea, with the average cost of shipping a 40-foot container between the Far East and Northern Europe at short notice hitting $4,343 last week. That figure is roughly 3 times higher than the exact same period last year, according to Zeneta's figures published in the FT. Why this is interesting is because the typical peak time for shipping prices is between late summer and autumn, which is when retailers start importing goods for Black Friday and also Christmas. Despite the recent rise in prices, the prices have still not yet surpassed the peak seen immediately after the Houthi attacks on vessels in last November. The wars in the Middle East is seemingly causing ship owners to prepare for the attacks, which could or may disrupt global supply chains through the autumn months. So obviously back when these Red Sea attacks were a kind of everyday occurrence, we were certainly covering them in great detail, and we spoke about the kind of rising world tensions as a result of such attacks. And we know, of course, that those attacks dramatically affected international shipping, forcing many international shipping routes which would go through the Gulf of Aden and Red Sea to divert around the Cape of Good Hope in South Africa, and that added to shipping times and therefore shipping costs. And we know that insurance cost for ships also went up dramatically, with certain ships being hit by missiles and drones, with this forcing course, many Western powers to send their own warships to kind of defend the shipping lanes within that territory. So a very interesting article there on a very important topic. That's all to talk about on the articles, though. Next to talk about is, of course, the charts, where, like always, lots is happening. And also, like always, we begin on the US 30, more broadly talking about the Dow Jones, or the US indices as a whole, where, of course, lots of things are to note. Now, last week we saw some very interesting price action, with the kind of on Monday price starting off really at these all-time highs. If we just take it back, if we just take price back from Monday last week to any previous all-time highs, you can see directly that price was peaking around that time to start off the week. As the week progressed, though, of course, we've now seen this significant sell-off for the US 30 and other US indices as a result, really, of the kind of developments with regards to US monetary policy and the kind of understanding of the Fed's outlook really changing. So, of course, the FOMC minutes was released last week, in which we were kind of provided with this insight into the kind of Fed's outlook and what Fed officials were thinking with regards to monetary policy and inflation and that sort of thing. And the kind of key thing to note from those FOMC minutes comments was, of course, the fact that inflation was seemingly more persistent than ever, and that rates were likely to stay higher for longer. And even if some data may show inflation's on the downswing, ultimately rates need to be held at significant levels for some time. And that kind of brought back, or put a massive down really on that recent inflation figure from the US, which did show that inflation was on the decline, which is why we then saw this massive sell-off on the US 30 and other US indices as as traders started to price in that reality. And that's why we did see this significant sell-off, with really Thursday and Friday continuing this massive move and pushing price further to the downside, breaking below this key liquidity zone that we'd previously noted and expected to act as a key area of bullish support, and also this key area of liquidity, which we previously noted as an area of all-time highs and resistance. And now price is sitting just above this next key area of liquidity and 50% Fibonacci retracement level. So that's the kind of key area to note, which prices next to interact with and could react to in a very bullish manner. So definitely look out for that kind of 38,900 level, as currently price is sitting at that 39,000 level. So definitely keep your eyes on the charts and keep on analyzing any key moves for the US 30 and other US indices. Next talk about, though, like always, is of course the dollar, where not too much is to say really, with price kind of swinging to the upside, ending off last week breaking just above this key liquidity zone for a short period of time before price once again swung back to the downside and broke back again below this area of liquidity. And now price is sitting just around the levels last seen in on the 22nd of May, but even Friday the 17th of May and also Wednesday the 15th of May. So really, over the kind of past few weeks, price hasn't moved much on the dollar despite these kind of upward swings and down swings. So keep your eyes on the dollar, but of course keep your eyes on any news to do with the US economy, as that's what will greatly affect the dollar this week. And we are receiving some very important US economic data this week, with not only as receiving the US consumer confidence figure, but also the US GDP growth rate. Added to that, we're receiving the US the US price consumer index figure, so US inflation rate figure as well. So we're receiving lots of important figures with regards to the US economy, and so lots of things to think about for the dollar. Next to talk about, though, is Euro USD, which had made some very interesting moves to end off last week, with price reacting to that key 50% Fibonacci retracement level, with price not making its way completely down to that 61.80, which lined up with this key liquidity zone. So of course that's very interesting to note, but what we're looking to see this week then is a continuation to the upside after prices reacted to that 50%, or will price now sell off from this area of liquidity that prices return to? So that will be the key thing to kind of look out for. Next to talk about is pound yen, which is continuing this kind of slow grind to the upside as price nears these all-time highs of 200 yens for a pound. So that will be a very significant moment once price does stay above that territory, as seemingly on Friday price did tap that level but sold off just a bit from that level as well. So I think that will be the kind of key area which price will need to break above and then hold above for markets to kind of acclimatize. So very interesting price action on pound yen, with price really struggling to make retracements that would usually be expected, like this retracement down to this key liquidity zone, which didn't end up fully happening. Next to talk about though is Bitcoin, which we'll have to cover shortly just because we're running out of time. But Bitcoin's obviously acting in very interesting ways with all the ETF speculation and news to do with Ethereum, and so as a result price is reacting greatly to these areas of liquidity after price struggling to break above $71,500 per Bitcoin last week. So certainly keep your eyes on Bitcoin this week, as these key liquidity zones are very active at the moment for Bitcoin. Next to talk about is of course gold, which also is making some very interesting moves after selling off significantly last week. With price making this significant downswing and now price reacting to that area of liquidity last Friday, as we had noted, or at least suspected would happen. So what will be interesting to see is whether price now can kind of move a bit higher after reacting to this area of liquidity, or will price continue this bearish momentum and drop below this key area of liquidity to the downside. Lastly, to talk about on the charts though is oil, where there's not much to say apart from the fact that price, after dipping to the downside last Friday, starting off the week, we are at a position which is elevated from those levels after price did kind of swing to the upside last Friday. That's all to talk about on the charts though. Lastly to talk about is of course the economic calendar, where, as I hinted to, we're receiving a great deal of economic data this week, so make sure to listen out for all the data coming up. For some reason my screen's bugged out at the moment for the economic calendar, but I'll go through it nonetheless. Firstly, we're receiving the German business climate figure, followed by the US consumer confidence figure, as well as the German consumer confidence figure and inflation rate figure. So two very important Eurozone figures there. And also an added US important and added to that an important US economic figure as well. As well as that, we're receiving the US and Swiss GDP growth rate figure, as well as the Chinese manufacturing figure and the Eurozone, French and Italian inflation rate figure. So lots of Eurozone data this week really. Followed by that, we're receiving the Italian GDP growth rate figure, as well as the Canadian GDP growth rate figure and US consumer price index. So that'll be the kind of key thing to listen out for as well for the US, but lots of economic data to listen out for nonetheless. We've got lots in the articles though, lots of the charts and lots in the economic calendar. That's all from us at Wildwood Capital. Have a great one. See you later. Bye.